Hey there, everyone. Ryan Schul with Straight Data Science. So, in the topic today, I want to look at how to monitor interest rate risks and try to help you to predict the impact of interest rate hikes and what kind of effect that will have on your portfolio, your investments, even your life, right? If you have a mortgage, I have a friend that had an interest rate only 7-year ARM, interest rates went up over the course of the past 7, 8 years, going back, maybe less, maybe 6 years, give or take. He had a 7-year ARM. When he got it, interest rates were pretty low. It went up, and he basically got squeezed out of his condo. He had to sell it and move on and do something else because interest rates are going up. And if you have an ARM or 7-year ARM adjustable rate mortgage, and now you have to pay a higher interest rate, it's a lot more expensive for the loan at this point in time. Okay, so this can help you to protect your portfolio value. We can try to predict credit risks and potential defaults on loans. I have a few videos that talk to this topic. Okay, what kind of impact is a rate hike going to have on your lifestyle, on your portfolio, on your investments? There's regulatory and stress testing requirements that need to be considered, right? What if scenarios? What if this happens? What if that happens, right? There's asset liability management, right? Um, and we have to account for that. I just sort of misspelling here. Let me fix that. And pricing and risk-based capital allocation can change very dramatically and very quickly in a high interest rate environment or is in an increase in interest rate environment. Okay, so we have to be aware of that. So let me go ahead and import or create some data. So I couldn't find what I actually wanted online. So I just created my own synthetic data set. I am getting the federal funds rate from Yahoo Finance. Okay, I'm going back to 2015. That is 10 years ago. Right now it's May 2025. So I'm going back to the beginning of 2015, a little more than 10 years and some change. And I'm looking at the interest rate and I'm taking that and combining that with the synthetic data set that I just created. So we have loans identified by loan ID, interest rates, the loan term in terms of months, like the duration of the loan, how long is it going to last, the balance, the DTI is debt to income, credit score for this borrower, and the start date of the loan, okay? And I will give you all this code so you don't have to make notes, you don't have to write this down and try to interpret it, in real time and pause the video. You can watch it from the beginning to the end, straight through, and just download the code at the end. I'll give you a link where you can download all this and you can copy it and paste it and run it in your own environment. So in this case, we're looking at the duration of the loan. This is called Macaulay Duration. This is basically the loan term divided by 1 plus the interest rate. So we try to understand the duration or the sensitivity. This is how sensitive the loans are to increasing interest rates. So you can Google this. I don't even think I have this on my notes, but as new loans get issued in a high interest rate environment, or if interest rates are increasing, or new debt gets issued, not loans necessarily, but new debt gets issued, it's going to pay the market rate. So it's going to pay higher interest rate. So the outstanding loans that are paying a smaller coupon payment or lower interest rates are worth less, right? So those bonds will be depreciated in value, and the new higher interest rate loans will appreciate in value because they're paying higher coupon rates, right? Like you just want more money. That's just human tendency to want more money. As interest rates are increasing, these new loans are being issued, new loans are, or new debt is being issued all the time. It's paying a higher interest rate. That's more desirable. The ones that are outstanding that are older are less desirable, right? But if interest rates decrease, now new debt is being issued and it's paying lower and lower, right? So the outstanding higher paying coupon debt is going to appreciate in value. It's going to become more valuable, right? Because people want to make more money. So that's what the Macaulay Duration helps us to understand. Okay, so enter to refresh this. So basically, if a loan has a duration of 5 years and interest rates increase by 1%, the loan value will decrease by about 5%. Okay, because like I said, if rates fall, loan values rise because the other older loans are paying a higher interest rate, right? New loans are paying the current market rate, but if rates rise, then loan values fall. Okay, so hopefully that makes sense. If it doesn't, just Google it. You can find a lot of information on the internet. It's very interesting. It's fascinating. I love these types of topics, right? And short-term loans are less sensitive to these changing interest rate impacts because it's going to be paid off in a relatively short period of time, 2 years, 5 years, maybe 10. Midterm loans and especially long-term loans are very sensitive to these interest rate changes because now you own a bond for 30 years. Now, if rates rise, right, new bonds are being issued that pay a higher coupon. The older bonds paying lower coupon are just less valuable. So that's going to depreciate in price. It's still paying you the same coupon payment, okay? So you don't necessarily need to sell that thing. You probably shouldn't sell that thing, but um, it just becomes less valuable and less people want that, and they'll pay less and less money, right? So it depreciates in price. So let's move down here, Control Enter to refresh the cell. Now we can try to predict default rates from interest rate changes, right? So again, like interest rate rise, um, and it depends on the duration of the bond. Long term is going to be very sensitive. It's going to bounce around more. Short term is a little bit less sensitive because it's going to mature faster, and it's just not around, and people just don't care about those as much. But for the long-term bond, it's going to be more sensitive, right? So interest rates are appreciating, and existing bonds depreciate in price. Interest rates decrease, and existing bonds appreciate in price, right? So there's always an inverse mechanical effect there, right? So here we see the interest rates, the loan term in months, balance, that's what I showed you before, debt to income, start date duration, that's what we just calculated, and the interest rate for that bond. And just below that, we see only the interest rate, the default of that loan, and the default probability after the rate hike. So this is very important too, right? So this has defaulted and the probability of default is 0.65. This is 0, right? Has not defaulted, default probability is low. This is 1, default probability is high. 0, low. 1, actually kind of low. 17 is pretty low, but there might be a threshold here around, uh, I don't know exactly where the flip point is, or where it kind of changes from one to another, maybe 10, 12%, something like that. But you can see the pattern here. Like this is defaulted, default probability is high, defaulted default probability is low. So I always say a picture is worth 1,000 words. Let's look at this in a chart form here. So as interest rates rise, you can see the counts. This is a histogram, so you can see the number of incidences of defaults and the number of counts. So it's going up, it's appreciating a little bit. Default after hike, and the default probability is illustrated right here. So let's look at one more um, example here. This is going to be the loan default. I'm going to append a new column onto this data frame. Okay, and we can see the interest rate changing right here. This is the change in the interest rate. This is 0.5%. This is 2%. This is 1.5%. Almost. I'm sorry. This is 1/2 of 0.5%, right? And this is almost 10% of 1%, and this is 0.5%. And then you can see the probability, the default probability after the hike. Okay, so we can see that there, and we can see this over here in this chart. We see the interest rate increasing by 1%, and then the impact on the default probability of the portfolio, right? So this gets like very serious very fast, right? I'm sure you remember the 2008 financial crisis when Lehman went down and Bear shut down as well. Bear went down in what, like March, I think, and Lehman was September. I think that was the time, and then it just gets spiraled out of control very quickly, right? When you get into these big financial scenarios. So hopefully we don't see that again anytime soon. Hopefully not in our lifetime, but who knows? Silicon Valley Bank went bankrupt. There's been a bunch of bankruptcies all over the place since 2008. So we're certainly not immune to that kind of thing, but hopefully we don't see these big ones, these big catastrophic juggernauts just falling off the face of the earth. It's hard to see that kind of stuff, but it does happen. So there's a couple more things I just want to introduce you to: the expected loss, the interest rate risk impact, and the total risk. That's what this calculation gives us right here. And if I go over to the side, you can see the interest rate increase 1%, default probability, and the expected loss, interest rate impact, and then the total risk of the portfolio. I gave you guys all the math right here. So I Googled this. I did a lot of research to put this all together. So I think this is fine. As always, if you see an issue or some calculation error or some logic error, please let me know. I did um, have one issue months ago. I put together a user-defined function, and somebody tried to run it. It didn't work, and they pointed it out to me. And I went back and was like, I looked at it closely. I was like, oh yeah, I made a mistake. So I fixed it, and then I reposted the code in the HTML file. So I'm not perfect. Like if you see an error or an issue, definitely let me know. I try to make all of this fact-based, very straightforward. You can fact check everything here. Okay, I think it's 100% accurate. Um, should be. I mean, as far as I know, I'm not putting out any kind of garbage out there. And honestly, like if I had a video that was subpar or not really like where I want to be, I don't even create those videos. Like I sometimes I test ideas. I had to delete two yesterday, but if it doesn't like have a certain standard, doesn't achieve a certain expectation from my perspective, I don't put these things out there, right? I'm just giving you like the best I can give. If you find a mistake or an error, let me know and I'll look into it. I'll research it. I'll fix it, and make it straight. I'll make it right. Um, and that's it. That's it, guys. So that's how to monitor interest rate risks and predict the impact of rate hikes on your portfolio of debt or loans or mortgages or whatever the heck you're dealing with, right? Like this does have a real consequential impact on people's lives, and yeah, this is the world we live in. That's how it works. Okay. So hopefully that was informative and educational, maybe a little bit inspirational. I try to like inspire people and make it a little bit entertaining too. I don't know how entertaining these things really get, but I try to put my best foot forward. So that's it. I'm going to wrap it up and I will see you guys in the next one. Take care.